Hello, everyone, and good morning or good afternoon, and welcome to today's webinar on deferring capital gains tax using the 1031 exchange. Now, we want this webinar to be as engaging as possible for you guys. So if you have any questions throughout the webinar, go ahead and use the little questions function, and I will ask the speakers the question on your behalf. We're also going to have a Q&A at the end of the webinar for you. And we're going to go through a lot of materials, but don't worry, about an hour afterwards, I'm going to make sure to send you a copy of the slide deck so that you don't have to worry about taking notes. You can just listen and discuss. So with that, I want to turn it over to today's speakers. Take it away, Joe.
Yeah, my name is Joe Leiden. I'm the co-founder and managing director here at LendSure Mortgage Corp, situated in San Diego, California.
Thank you. Mark?
Good morning. My name is Mark Lutzi. I'm a regional manager out on the West Coast, California specifically, and I'm happy to be here.
Francis? Francis?
She's there.
I'm here. I'm unable, unfortunately, to hear you when you transferred to take it away, Joe.
Oh, I'm sorry. So let me know, Francis, if you have any other issues with your audio. You may have to use the call-in number or leave and then reach out.
Okay.
All right.
Thank you.
Thank you. Okay.
So today, we're going to talk about some products at the end of this presentation that will help you, we think, sell more loans. Obviously, that's what business we're in, you and I. We're in the business of doing loans. And so we're going to talk briefly about these topics in front of you: capital gains on investment properties, 1031 exchange, reverse 1031 exchange, and bridge loans with the reverse 1031 exchange. But a couple of footnotes. So we are not experts, tax experts in the accounting arena. We're not CPAs. We're going to talk to you about some concepts that relate to taxes, the 1031 exchange. Some of the concepts that we're going to talk about here, many of you may be fully aware of these concepts. I'll ask you to bear with us. The presentation has been set up in a way that kind of starts with some base knowledge that we're going to try to impart, and then we build upon that knowledge to get to some of the concepts that we think that will be new to many of you. So just bear with us, and we think you'll find it informative to you and helpful. Rose, do you want to move to the next slide? Okay, so the target property investor, we used to have 6 bullets here. I got rid of all 5 of the 6, because really this is the investors. It's all active investors, and underline the word active, because anybody that's owning, buying, and selling investment properties should at the very least be informed on these concepts that we're going to talk about today. So it's all active investors. And anybody selling loans to active investors should probably be informed on these topics as well. Okay, so this is kind of a basic capital gains. Okay, so I don't mean to speak to the choir here, but I'm going to go basic on you. So let's just assume someone buys a property in 2002 for $200,000. Jim, we'll call him Jimmy. He purchases that investment property for $200,000 in 2002. He didn't do much to it, but he did spend $15,000 in improvements, and he can document all of those improvements with receipts. And so that takes his basis from 200 to 215,000. He sells the property in 2023 for $800,000. So in order to determine what the capital gain is going to be on that property, he's going to take his sale price, $800,000, and subtract from it the basis, 200 plus 15, 215, and you get to $585,000. So the capital gain is going to be on that. Now, I won't get into the minutia here, the selling costs and whatnot, probably is not going to be included in that. But let's just say that it's going to be in that high $500,000 range, that he's going to have a gain, and the US government likes taking all of our money in the form of taxes. So in this case, it's a long-term capital gains tax, and the federal government's rule is, it says we're going to charge up to 20% of that gain. Okay, now California is one of 6 states that also charges capital gains tax at the state level. Okay, most states do not have their own capital gains tax, but California does. And it really doesn't matter. The numbers in front of you are totally estimates, because when you get into state income taxes, they all differ from one state to the next. That's why I started this conversation out with, we're not tax experts, we're not CPAs. Suffice it to say, you're going to have at least $117,000 federal capital gains tax on this transaction. So when you go to sell the property, after you've sold it and you get to a place where you're filing your annual tax return, your accountant is going to say, well, okay, we've got to now pay this capital gains tax to the IRS. And so it can be very significant if you've held the property for a long period of time and there is a significant gain. Okay, so what is a 1031 exchange? So a 1031 exchange is a tax concept from the IRS that says, I could read these bullets, but I'm not going to read it. I'll scan them. I'm just going to give you the concept. So it's a tax strategy that enables an investor to swap one investment property for another without incurring the capital gains taxes. Essentially, I like to think about it like this. You're pushing your capital gains into the future, okay? And so investors can defer the capital gains tax on the sale of the investment property by reinvesting the full proceeds from the sale into a new investment property. So you can't defer the tax unless you buy another investment property, okay? It's a good way to save on current expenses and continue building their real estate portfolio, because you're not having to pay that giant capital gains tax that I just mentioned. You could use those monies to buy property and grow your portfolio. So the property being sold and the property being acquired must be of like kind, which generally means they're both real estate properties held for investment. The fair market value of the replacement property, the new property you're going to buy, must be equal to or greater than the sale price of the original property to defer all of the capital gains taxes. Within 45 days of selling the original property, the investor must identify a potential replacement property in writing to a qualified intermediary. The investor must close on the replacement property within 180 days of selling the original property, or by the due date of their tax return, including extension of the tax year that the original property was sold, whichever comes first. So again, you can get to with your CPAs and get more definition around this. The concept here really is about pushing your capital gains into the future and using those gains, that savings, for down payment money to buy other properties, investment properties.
Joe, Rebecca wants to know, it's not required that you reinvest all proceeds, is it?
Well, now you're asking me to be a CPA and a tax professional, and I won't do that. I don't want to even dare to come close to answering that question, because I don't want to be deemed to be a tax professional. That's something that you're going to check with a CPA with and get that question answered by that kind of a person.
Understood.
So the 1031 exchange process. The investor engages the qualified intermediary who will facilitate the exchange transaction. the QI, we'll call him the QI, the qualified intermediary, will hold the proceeds from the sale of the sold investment property. We call it the relinquished property, and assist with the necessary documentation to ensure compliance with the IRS regulations. Within 45 days of selling the investment property, the investor needs to identify a potential replacement property. They can identify up to 3 properties of any value or any number of properties beyond 3, as long as their total fair market value does not exceed 200% of the sales price of the relinquished property. The investor enters into a purchase agreement with the seller. The agreement must include the appropriate 1031 exchange language to preserve the tax deferred status. At the closing of the relinquished property, the proceeds from the sale are transferred directly to the qualified intermediary. After the sale of the relinquished property, the investor has 180 days to complete the exchange. Within this time frame, they need to close on the acquisition of the replacement properties using the funds held by the qualified intermediary. The qualified intermediary will transfer the funds to the seller, completing the exchange transaction. What's important here is that you understand that there is a process and that you need to step through these steps to get the appropriate tax treatment. So you definitely want to guide your customers to talk with their CPAs to have them guide them through it.
Okay. Derek wants to know, can the new property be a lot with new construction costs? Mark, do you want to take that one?
Rose, I'm sorry, repeat the question.
Can the new property, the replacement property, be a lot with new construction costs? So a plot of land that you build on.
So it could be, but we're not able to finance that. So LendSure couldn't participate in that.
Okay. What if it's multiple lots with houses being built that exceeds the sales price?
That's one for Joe.
Again, it's a CPA-like question, and I've been coached by my attorneys to not dare go and try to answer those questions. Okay? And I won't do it. He's probably listening into this conversation.
Well, Julie wants to know, if someone was selling 2 investment properties to buy 1 investment property in another state, equaling the amount of the 2, would that be allowed?
See, you have me wanting to answer that question, but again, it's a CPA question. I'm going to say, check with the CPA.
You should have had a CPA on the call. All right, so let's take a look at the next one. Joe, do you want to take us through this one?
Sure. So let me just walk you through an example, okay? The investor owns several investment properties, including a house in Marietta, California, that he purchased 15 years ago for $188,000. Rose, can you stop typing, please?
Sorry.
He's been renting the property to long-term tenants, okay? He put $65,000 in improvements to the property, bringing his cost basis for the property to $253,000. 188 plus 65 equals 253. The house needs a new roof, costing $30,000. Instead of spending $30,000 on a new roof, the investor wants to buy a new investment property that does not require major improvements. Now, before I go on, this is the real interesting point about 1031 exchanges and why it's important for many investors out there to know this stuff. So this happens to be my property, so I'm very familiar with it. And the truth is, houses get to a place where the major issues start to fall apart, like roofs. They have generally 25 to 30-year lives on them. And they're expensive when you replace them. I just replaced a roof on a Florida property, and it cost me $75,000. So it's not an insignificant cost. HVAC is another thing. When you have mechanicals that need to be replaced, heating, ventilation, air conditioning, those today can be low side 10,000, high side 20 to 25,000, depending upon the size of the house. So those are major expenses. in this example, this house that's now worth $600,000 needs a new roof. It's going to need a new roof in the next couple of years, and it's going to cost $30,000. And the mechanicals are probably going to need to be changed here in the next couple of years, and it's going to cost $10,000 to $15,000. So the thought is, well, instead of spending $40,000, $45,000 updating those systems, by the way, you won't get it in more rent. You're just going to be out of pocket that money. And so that's likely a full year's rent that you are going to use to spend on upgrades. So that's really the important learning moment as it relates to 1031 exchanges. You can instead buy another property that's maybe the life of their roof is only 10 years old, and so you got another 20 years in front of you. So you go out looking for a newer property with systems that are not used and abused, and you buy it, and you are going to trade the old property without having to pay capital gains taxes. Okay, so I'm going to go back to bullet point 4. So property is now worth $600,000, so it's appreciated by $347,000 over the cost basis of $253, putting me in a position where he has to pay a significant capital gains tax. Assuming a federal capital gains tax of 20%, California of 7%, the combined capital gains would be $94,000. So when I go to sell this property, if I don't use a 1031 exchange, I'm likely going to send $94,000 to the US government so that they can spend it on things that I won't be happy with. Okay, so using a 1031 exchange, he's able to transfer all proceeds of the sold property to the new property. So I can take that $94,000 and say, I'm going to go buy a $700,000 house and make sure that it's newer, and I don't have to replace the systems, probably improve the rent situation. So financially, it makes a lot of sense for me to use a 1031 exchange. Okay, and for most investors, the same is true. Okay.
Joe, Julie wants to know, how do you need to document those improvements?
Oh, well, you should have my wife. She can document any improvement, any money that we've spent in our house. We have that receipt in a file. So you keep all of the receipts for improvements on your property. Now, again, it's a CPA question. You have to check with your CPA on what is an improvement. So just buying fertilizer to fertilize the shrubs doesn't qualify. But if you have, if you put a new roof on, that's an improvement. In this example, the $65,000, when I bought that in 1988, I basically improved the interior of the home. I repainted inside, outside, put new carpeting in, put new bathrooms in, did a lot to it. So I kept all of those receipts that qualify for, to be used against the basis of the property. You check with your accountant, they'll give you a list of those things, and then you keep receipts. And then, because you don't want to pay capital, you don't want to pay taxes on it. I mean, well, maybe some of you do. I certainly don't want to pay taxes on any more taxes than I have to. So we keep receipts. Keep the receipt.
Okay. Right. And Jose wants to know, does the QI need to be involved prior to the sale of the first property?
Ask that again.
Does the QI need to be involved prior to the sale of the first property, the departure property?
I think that he is asking a question that you're going to be getting into next, which is basically identifying the difference between a reverse 1031 and an actualized 1030, or a 1031 and a reverse.
No, I think his question was, should you have the QI involved? The answer, I think, to that is you probably should have linked yourself with a qualified intermediary, a company that is skilled in doing these types of transactions, 1031 exchanges and reverse 1031 exchanges, because those folks together with your CPA, they're going to be the people you're going to rely on to navigate through this process. It's after you've done one, you're going to say, well, oh, that was easy. But it's going to be some new stuff for you, and you're going to say, oh, okay. And it's really a new process. So getting them involved in advance is a good thing, so that you know the process, and they will coach you through the process. Okay.
Joe, I've got a couple of different people asking about how long you have to wait before the new property can be a primary residence as opposed to an investment property. Is it a year?
That's another one of those CPA questions. Good question. You should write all these questions down, and as Rose will tell you at the end, we do record these, and we will send the recordings to you. It'll be online for you, so you can keep you know, a running tab of all of the questions that have been asked, because they are good questions, and you should take those questions and put them in front of both the CPA and the qualified intermediary. But I'm not, if it's anything close to like talking taxes, I've just been advised not to answer those questions. So I'm not trying to be unfriendly.
Got it. Joe, Susie wants to know, Joe, as an investor, is it true you can face depreciation payback as well as capital gains?
Ask that question again.
Joe, as an investor, is it true you can face depreciation payback as well as capital gains?
Again, it's a CPA question. I don't want to go there. I think I know the answer to most of these questions, but I'm not going to turn into an advisor on this call. Okay.
And I've got a bunch of people asking, yes, you are going to get a copy of the slides. Look for an email from me, Rose Waldy, about an hour afterwards, and it'll have a complete link, a link to the complete slide deck, as well as some non-QM resources, a white paper, marketing materials, etc.
That was a good question there, because it's going to help you with putting together your sales approach when you're dealing with investors. Okay, that's why all of these questions are indeed good. I'm not trying to shine you on at all. I'm saying capture them all on the recording, and then write them down, and then get in front of a QI company or a EAT company and a CPA, so that you can put together a good pitch when you're talking with investors.
Okay, and then speaking of which, Mark wants to know, who is a QI? A realtor, a CPA?
They work for a tax exchange company. I don't think they're a realtor. They may be a realtor, and they may be a CPA, but that's, I don't think, required. But they are an expert and work for a tax exchange company.
Joe, I've also been asked by loan officers if they replace like an escrow or a title, depending on the state. And the answer is no. The QI is actually in addition in the transaction that is facilitating this exchange. So you'll still need escrow and title just like you normally would on a real estate transaction.
Yes, that is very true.
Okay, great.
Okay, so now up until this point, we've talked about the basics. Okay, capital gains taxes, and then avoiding capital gains taxes through the use of a 1031 exchange. So now we're going to add a little spice to the mix. We're going to talk about the reverse 1031 exchange. So what is that? Oh, okay. So I just want you to imagine it's reverse. Well, I'll read the bullet points. How about that? A reverse 1031 exchange lets the investor buy the replacement property first, while still deferring capital gains taxes on the subsequent sale of their original investment property. So now you're confused because of all of what I just talked about in the preceding slides. You're going to say, "Well, no, I'm confused now." So stay with me just a little bit longer. Great option when an investor finds an ideal replacement property that they don't want to miss out on, but they haven't yet sold their original property. Okay, fairly simple. Okay, next slide. Oh, wow, look at all that detail. Okay, more bullet points to read. Okay, Before I get to these bullet points, I want to just talk to you like a layperson. Okay. Imagine a person. No, I won't do it because I think it's in my next slides. Forgive me. Rose, I'm gonna talk to him about the bullet points. Investor engages a qualified intermediary who will facilitate the exchange transaction. We talked about that person. The QI will guide them through the process, ensure compliance with IRS regulations, and hold the funds during the exchange. Okay, we talked about that already. The QI provides an exchange accommodation title holder, EAT, typically an LLC, that will temporarily hold the title to the replacement property on the investor's behalf until the exchange process is completed. I'll come back to that in a minute. With the EAT in place, the investor can proceed to acquire the replacement property. The transaction will be structured as if the EAT is the buyer. Investor identifies the relinquished property to be sold within 45 days of the purchase of the replacement property. The investor has 180 days following the purchase of the replacement property to sell the relinquished property. Once the relinquished property is sold, the proceeds from the sale are transferred to the QI, who then completes the reverse exchange. The QI will transfer ownership of the AT to the investor, concluding the exchange. Okay, that's probably the most important slide in this whole deck. You have to read it about 5 times to get it. Okay, let's go on, Rose. Okay, so here's an example. This is a deal that we did a few weeks ago. Investor lives in Lake Tahoe. She sees a property go on the market down the street from her home. She says, I want to buy that house. And she knows that the Lake Tahoe is a very hot market, and she wants it to make an offer immediately. And she is going to hold it as an investment property. She also knows that she owns a property in Bozeman, Montana, that's worth roughly $900,000. And she's thinking in her head, well, I don't want to pay capital gains taxes, but I don't have Bozeman sold. I haven't even listed it yet, and I haven't made an offer. And I want to make an offer that is compelling. So most of you know that in the market that we are presently operating in, a compelling offer is an all cash offer, or a compelling offer is close in 30 days. A compelling offer is close without inspections. A compelling offer is and buy it as is, where is. So I think most of you know that that's what makes a compelling offer. So when you're in a tight real estate market, you gotta, if you want to win the property, you gotta put forth a compelling offer. Okay, so that usually means you gotta move fast. Okay, and so this person's thinking, well, I still want the tax effect of the 1031 exchange, but I'm not going to have time to sell Bozeman and go through that process that we've already talked to you through. So she wants to buy the property in Lake Tahoe down the street, and she does. So she gets under contract. She first calls her QI and gets that entity to coach her. And then she says, okay, I want to buy this property. Now I need to find financing for this property and get it financed before the Bozeman property sells, but I still got to deal with all of the tax issues associated with the Bozeman property, and I have to deal with safe harbor, EAT, and all of that. So that's what a reverse 1031 exchange can help with. So the preceding slide will take you through those steps. And you do need a QI involved to go through the steps properly, but that's the way it works. So you can buy a property before you've sold your previous rental and still get the tax benefits of a 1031 exchange. That's what a reverse 1031 exchange is. Okay?
Joe Dennis wants to know, is there a way to extend the time frame if you cannot locate a replacement property in the 180-day time frame?
No.
Okay. Is there an extension? Sarah wants to know, is there an extension on the 45 days?
I'm not capable of answering that question with confidence.
Okay. So I've got a couple of questions here, and I know that we talked about it a little bit, but about replacement properties, selling one investment property, replacing that to 2 investment properties or 3.
Yeah, I think you're okay with that.
Okay.
Okay. Financing, I don't think this one's for me. So if Mark, if you want to take this one, you can. If you want me to take it, I can. I can continue to go with this.
Yeah, Joe, go for it.
Now, before you go, Mark, so Mark and Francis are sales people on the front lines. That they deal with folks like you every day of their lives. They love loan officers and brokers. That's who they deal with every day of their lives. So they are the ones that can share with you how some of these concepts can, the knowledge of how they can help you sell more loans. And they're now going to talk about some of our products that can help you work with this 1031 exchange and reverse 1031 exchange. So I'm going to bid you farewell and let them take it into the end zone from here.
Well, Joe, I appreciate all the help getting us here. Just to kind of quickly recap, we've discussed capital gains and then ultimately the 1031 exchange for an investor. Then we've talked about reversing it and buying before you sell as an investor with a reverse 1031 exchange. Now we come to the reason that we're actually all here, and that is to talk about LendSure's unveiling of our bridge loan program for investors that are doing a reverse 1031 exchange. So this is a specific audience. This is an investor that sees an opportunity. They want to strike on it while the iron is hot, and they ultimately want to put in a compelling offer, as Joe would state. Some of these investors are equity rich and asset poor. So because of such a strong run of appreciation that America has received, we see that there is a need for investors to access the equity in their real estate portfolio for future down payments or home purchases, instead of using their own assets that they may have locked up in investments. So ultimately, that's where the bridge loan idea came from and what we're about to express here. So the first bullet point is to purchase the replacement investment property. The investor needs cash from the original investment property. Since the funds from the sale of the original property are not yet available, a LendSure bridge loan can provide the funds to help buy the replacement property by allowing the investor to borrow against the equity in the original investment property, hence our bridge loan. So immediately you guys are going to ask, well, what LTV can we go to? We can go to a 60 LTV, and we're going to get into more of the program specifics. So LendSure's bridge loan is a 6-month loan with no payment due until the sale of the property or the maturity of the loan. It is very important for you guys to understand. You just saw that the IRS code is 180 days. Our program is built around that logic so that the investor is able to maximize the timelines that they have allotted from them. But in tune, they are able to still receive market rents from their departing property as it's rented out. So that's a key feature for our bridge loan. It has 6 months of no payments. And if there is a mortgage on there, LendSure pays off that mortgage and then allows the equity up to 60 LTV, okay? By accessing the equity in the original investment property, the investor can use the capital for a down payment on the replacement investment property. If liens exist on the original investment property, they will have to be paid off. The remaining funds need to be needed for closing will come from a purchase money transaction on the replacement investor property. So hence, we do 2 loans. We do the bridge loan, The equity in that loan is then transferred over to the down payment of the purchase, and we do the purchase loan for the investor as well. So it's really 2 loans for you as a loan officer. LendSure's bridge loan requires a borrower to finance the replacement investor property with LendSure and does not interfere with a 1031 exchange tax benefits. Why? We have the intermediary that the EAT that is handling the transaction for the investor on both sides. All right, Rose?
Yeah, and Athena wants to know, if the reverse 1031 exchange requires that title be vested in an LLC, what product is LendSure offering to this?
So that's a great question. I don't want to get into too much detail, but the IRS, for the investor to receive the 1031 benefits, they have to follow by a certain set of rules. We have the rules, we're putting them on display for you, and it requires that an EAT actually purchase the property for the investor in an LLC. The LLC has the investor's names attached as, I believe, Joe, do you know what they're assigned as? The investor is to the LLC? Can't remember that. Oh, you're on mute.
Okay, so I think you asked, I'm sorry, I was doing email.
It's okay. So Joe, the question basically is regards to the LLC having to be the entity that purchases the property. Yes. And why? And then how is our borrower involved in that LLC?
Yes, so you cannot be personally involved with the purchase of the property. So the QI, qualified intermediary, helps set up an LLC. And the LLC buys the property. But they make you the managers of the LLC. So you do sign, on behalf of the LLC, but you don't own the LLC. Okay? So that's the way that works. And then once the property that you own already sells, and the QI, goes through their process, they will then sell the property from the LLC to whatever you want it vested in, to your personal name, to your trust, to your whatever. So that's part of that process. That's why I said that slide that I walked through earlier with the 7 or 8 bullet points was important. And that's why it's also important to get with a QI in advance so that you understand what is going to take place.
Correct.
I've got a couple of different questions. I'm sorry, Mark, about the entity that is the borrower. So does the EAT become the borrower? That's what Jeff wants to know. And Jody wants to know, do you lend on the new property while still in the name of the trust intermediary?
The technical answer is the EAT does become the borrower. Their actual investors are signed on to the LLC as managers or custodians. So really at this stage of the process, the investor has 2 options. They can take their own assets and hand it over to the intermediary as they form that LLC. And those assets then are used to purchase the property, or they can utilize, in this case, LendSure's bridge loan program and utilize the equity in their real estate portfolio. Those funds then automatically go to that EAT, and then they're used to purchase the property. So hopefully that explains that. This piece can be quite complicated. So
let me add one to that. So Mark is pitching his bridge loan because he loves bridge loans. I do too. It's a great product. However, going back to my Lake Tahoe Bozeman example, in that example, if that woman had, the purchase price was $10.50. If she had $500,000 in liquid cash herself, and she was willing to put that $500,000 down, she could come to us or to any other lender and say, hey, I want to buy this property. And she would obviously need the balance, $10.50 minus $500,000, or a $550,000 loan. She doesn't have to access capital from the Bozeman property, but she can. Okay, so I'm just kind of explaining that you can go multiple routes here. If they have the capital to buy it, that they can do that. But if you don't have the capital, LendSure will finance on both properties. If you don't have the capital, you say, okay, I'm going to go borrow money on the Bozeman property. Let's say it's worth 900. I want 60% of 900. 6 times 9 is 540,000. Take 500,000 over, put it as a down payment on the Tahoe property. Boom. And then, okay, they got $500,000 down payment on the Tahoe property. Now they need another 550 to close it, plus closing costs. Call it 600,000. Boom. So we do a first on the $600,000 first on the California Tahoe property, and we do a $500,000 first on the Bozeman property. Boom. We got 2 loans. One is a loan as a bridge, which has no payment on it, and that's ultimately going to sell, and we're going to get paid off here in the next 60, 75, 90 days. And then the woman will have a $500,000 30-year mortgage left on her Lake Tahoe property.
Okay.
Rose,
So
if you advance the slide deck 1 page, you'll see exactly what Joe just said.
Oh, sorry about that. Didn't mean to.
It's okay, Joe. You've memorized this presentation, I could tell.
Well, before we get into that, I just want to clarify, because Alyssa says this is related to what you were just talking about, Joe, about for the reverse 1031, 2 loans are required. What if she doesn't want a bridge loan? Can she still do a reverse 1031 exchange?
Yes, that's absolutely feasible. We'll handle the 1031 exchange. We'll handle a reverse 1031 exchange, and then we'll also handle, for those investors that require some financing for their capital, we could do a bridge loan on the reverse 1031 exchange.
Okay.
And just, well, I want to add this in. The LLC is one of the biggest hangups in our industry. A lot of investors can't find a way to figure that out and be okay with it. LendSure, that's really the design around our bridge loan, is being okay for the Inc. to actually create the LLC and fund within the LLC's name, and us ultimately doing the bridge loan for them. So.
Okay.
Would you like me to go over this slide here, Rose?
Yeah, I think this one is assigned to you, Mark.
Yeah, so this is exactly what Joe just got done speaking about. This is back to the property in Tahoe, so I won't spend much time on it, but you can see to the right the formation of the 2 loans. So if we were to do a reverse 1031 and we were to do the bridge loan for this investor, this is exactly what it would look like. Okay, and so ultimately we're able to close these transactions almost simultaneously, because both of them are non-owner occupied and they don't require TRID. So during that process, we're able to usually fund within a 48-hour period between the 2. Unless we have more than one title company or escrow company involved. And if a wire needs to be transferred to another company, then that would create a day lag. But ultimately, it's very quick.
Okay. Mark wants to know, what's the advantage of using a bridge loan over a cash out refi on the investment property?
That's a good question. So go ahead, Francis, did you want to interject?
I feel that the questions are now leaning towards where I feel they take us back to the initial, what is the value of the LendSure bridge, and what is the value of a bridge loan in and of itself? And do we want to have somebody that, say, has $6 million in the bank, but they want to tap into the equity of their home and pay 9% on 9% interest rate on bridge loan financing, and how that investor is looking at their greater portfolio and what their investments are spending as far as yield, and do they want to go, and are they able to go and get a margin line against those investments? And it really then is trending toward the conversation that Mark and I like to have and your AEs like to have, and that's about pricing and about how the actual bridge is structured. One of the key benefits of both the reverse 1031 bridge loan product, as well as the just simple bridge loan product when you have identified a property, is the fact that with the bridge product, when it's a non-owner occupied and it's the 1031, you're talking about a 6-month bridge. When it's the longer bridge product, you're talking about a 12-month bridge, but the borrower is not required to make payment and can still receive rent on the property that they might be selling when you're talking about a reverse, or the property they're acquiring. So the borrower is not obliged to have to make actual payments out of their own pocket and their own capital during that time frame. So if you take yourself back to the slide it's several slides ago, but when talking about just the cost of repairs and what does my monthly look like, your investors are looking at those things when they're buying these properties. They're looking at what is the cost of a roof going to be? What is my monthly looking at 9% interest only? And am I in this thing for 6 months? Am I in this thing for 12 months? What's the permit process with the city? All of those things I think they are things that your investors are thinking about. If they're seasoned investors, if they're newer investors, there are conversations I think you should be having. So one of the greatest aspects is that they do not have a payment associated. The payment is out of the equity in the transaction once the bridge loan itself closes. And then looking at what 9% look like on whatever kind of a cash we're talking about compared to what are they yielding on their stocks, bonds, etc. And is it worth it to liquidate? And by the way, you're the salespeople out there. Do you want to do loans? They can go and use their own liquidity, or do you want to sell them on that product?
So Francis, a good example would be this particular borrower, since this is your loan. I remember that this woman that was interested in the Lake Tahoe property had a large amount of assets, personal assets, to the tune of like $8 million or something, correct?
Yes, she did. She had $8 million and she paid 9.5% interest for 3 different months.
Right. So
Totaling $2 million. It's not a hard sell. And she paid 3.5 points.
So the interesting part about it is, well, the normal question would be is, well, why doesn't, she just use her own assets? The answer was, well, her assets were spinning off a 17% return. So when you kind of look at it from that viewpoint, 9.5% is incredibly affordable in comparison to losing 17% return on an asset. So anyways, every particular transaction is going to be different. Every investor is going to need to identify their source of capital and what makes the most sense for them. This is a tool that allows people that are equity rich, that need to utilize their equity and still receive the tax deferment that the 1031 allows. It's kind of it's doubly yoked. So an investor that is asset poor but equity rich, this is the perfect tool for them. So
one more thing, and I don't want to get too off course here, but LendSure is a specifically non-QM lender. So we are well-versed, incredibly well-versed in non-QM product, meaning we could do an entire other slide deck on these other ways in which you can give your borrower an ability to re-engage their relationship with leverage. So talk about like an asset depletion program where you're you can take your assets, you divide it over 60, and suddenly you're looking at an income figure whereby they had a great CPA who know how to write it all off, and you're able to qualify them on a non-owner occupied purchase, and we're really entering a pricing conversation. But you pair this product alongside what you can get them as far as leverage, and you're really becoming their partner on an investment basis.
So Rose, could you advance this slide just one? I just want to remember where we're at here. I think we're done with the reverse element.
I do have a couple of questions. First, is the bridge loan available in Texas?
So the reverse bridge loan is available in Texas, but due to the Homestead Act, we're not able to do any owner occupied property bridge loans. And just a quick shout out, about 40% of LendSure's pipeline is currently owner-occupied bridge loans, or bridge loan program for the owner-occupied to owner-occupied is incredibly popular. We're hoping for the same amount of success on this 1031, reverse 1031 exchange bridge loan.
Okay, great. Okay,
Go ahead, Francis. You can finish this last slide here.
Okay, let me see. Well, I guess it's kind of like a recap, but yes, it does allow the investor to proceed with an acquisition of the replacement property. They can go out shopping. You can get with the QIs. I honestly recommend, like when you talk about who do I sell to, I remember when I got into this business, who do I go and sell to when no A-paper LOs wanted to talk to me? I said, okay, this is who you should sell to. Go talk to QIs, go talk to tax attorneys, go get well-versed in this space, and let them know that you have this product so they can be talking to their clients about really potentially not tapping into their liquidity. They can avoid missing out on potential replacement properties. They have the ability, if they're well versed in the product, and you go and ask the questions that were identified on the CPA side that Joe would not answer, so that you can be well versed in talking to the borrowers. Again, I mentioned a few minutes ago, the ability to collect the rents on the departing property whilst not having to pay a mortgage payment out of pocket and deal with the new property is huge. It's all coming out of the equity. It's, if you really become to understand the product and then the pricing alongside of the product, selling the points will become seamless in my eyes. But
So
that's really
Francis,
for you to get with your AEs. And
I'm sorry to interrupt you. I just want to make sure that we have time for these last 2 points. So we both can agree the popularity of the DSCR program over the last 5 or 6 years in the marketplace has been huge. That's investor driven. You have a lot of people that have started to further increase their real estate portfolio. With DSCR being kind of a normal loan program today, walk people through on the call today how you can kind of hitch the DSCR to the reverse bridge loan.
I mean, the DSCR loan, I'd say you should actually take that, your own question, because you said it beautifully the other day. But I mean, the DSCR product has become a huge product in the marketplace. In fact, for a while there, you were seeing the DSCR on a secondary basis price out alongside and better than Fannie Freddie, because they didn't want to touch your self-employed people and they didn't want to touch your investments. So the DSCR product became so huge for these investors. Hopefully you capitalized and you got with those investors. And now those investors who are in on those properties, they might need an out. They're right there, sitting there, and they need access to the equity because of, especially in your markets that are more saturated, that prices still haven't gone down and their equity's up, but they're needing to get out because of rents or whatever. Rents haven't gone up, or they're in interest rates and they want to find a new acquisition. I just think like the idea, if you did leverage DSCR, you have a base of people that you should be calling tomorrow to talk about this with.
Yeah.
And
that's exactly my point, Francis. I'm glad you said that, because people that do have experience with financing DSCR loans over the last 4 or 5 years, some people are going to say, well, where do I go start soliciting to this bridge loan, reverse bridge loan program to? Is it real estate agents? Sure, absolutely. But if you really have a honed in strategy, it would be going after the investors that have already financed with you. They've used the DSCR program and they're looking to grow their real estate portfolio. The last thing is we're in a market that's calling for this program. It's actually dictating the bridge loan need. We're seeing that in the owner occupied space and now in the non-owner space. If you plan on winning an offer that you're going to put in and you're really planning on winning and you're a contingent offer, it's not going to happen. We all know that nationally. That is not a poor, that's a very poor decision on the buyer's side. Being non-contingent is really your only possible way to get into the circle of the possibilities that a buyer's going to select you. So, or a seller's going to select you. So
And just
with this tool being
drive home one point, the bridge loan and the reverse 1031 bridge loan, regardless of the DSCR borrowers that you tapped into and you were able to create these relationships with, we all know the agent is the best relationship because referrals continue. The bridge, if you can understand it, is the perfect pitch because it gives them leverage to know how to list properly.
And we have a couple of related questions regarding the list. One question is there a prepay penalty on the bridge loan? And Gabriel wants to know, can you explain the terms of the bridge loan and do you charge points or not?
Go ahead, Francis.
There is no prepay associated with the bridge at all. Obviously, the market is changing and adjusting at all times, and it's so fun. I think it's at 2% to LendSure right now in terms of bridge. Correct me if I'm wrong.
2.5 for the reverse bridge.
2.5. The 2.5 is the reverse bridge. I think on just a typical bridge, you're at a 75%, and maybe we're at 2.5. And I think that we can finance to 77, but that's talking about stacking and whatnot. Though, again, for those that have done business with LendSure, for those that haven't, 9 out of 10 loans have an exception. Bring me something, talk to me about a product, or talk to your AE or whomever about what you are trying to accomplish. And they are your non-qualified expert to help you get to the finish line and make the exception and blah, blah, blah.
So Francis, I'll add on to that just a little bit. I'll talk to you real quickly about the pre-qualification process that LendSure does. So in this case, we would take investors on the property that they plan on selling, and we would get them pre-approved. We would introduce the QI. If they don't have one, we can refer you one that we work well with, and get the preliminaries moving so that when they do spot an opportunity in the market, they know that they can make an offer and it would be non-contingent. We also run into some investors that have already started moving down the road. They spotted the opportunity and they need to move fast. So just to give you an understanding, we have the ability to close these loans pretty much as fast as you can. In regards to the only leveraging point would be the appraisal. So we got to have an appraisal on both properties. So if we can get an appraisal quickly, we're moving as fast as you can on getting a reverse 1031 bridge done for you.
Okay.
Yeah.
And then I'm trying to find the question, my apologies, but there was a question on when they have to transfer the loan back from the entity to the borrower. Is that a whole other set of closing costs? What are the costs associated with that?
So I think you're talking about when the EAT closes out the exchange, correct?
Yes.
Now so those costs from the EAT are identified up front to the investor. They know exactly what that transaction is going to cost them. And closing that out, it would be just simply removing the LLC from title as being the actual lien holder, and then they in turn put it into the title into the name that the owner would prefer. Sometimes it's going to be their own. Sometimes it could be their own LLC that they want to transfer it to. There's lots of different tax advantages. The CPA would give them the best guidance on that.
And to whomever just asked that question, you actually just identified yet another selling point. And that is to not have to deal with two different title escrows and the costs associated.
Okay. And Victor wants to know, are you required to use the full amount of the appreciated value to buy the next home, or can the borrower save part of it?
So that's a good question, and that's going to be geared towards the IRS rules. Some of those rules we've already put on display for you. If I answer that question, I'd be giving you tax advice. So I do know that any funds that aren't used for the exchange are a taxable event. So you want to guide through. You want to get some real clear advice from a CPA and also a QI. They will be able to answer those questions for you with great detail.
Okay. Are you done with this,
I
Mike?
think that I have to drive this point home with regards to how many questions we've had to pass back to you and say, get with a QI, put those questions down on a piece of paper. If you identify the amount of questions that you had over the course of the last hour that you have answers, it's the easiest sales call you've ever done to these salespeople I'm talking to on this call. You have a bullet list of questions to have a long conversation and develop a relationship.
Gabriel says, are we good to do those in Florida? And I would love to have Frances contact. I'll let her answer the Florida question, but Gabriel, go ahead and respond to the email that I'm going to send you in about an hour with the recording, and I will be happy to connect you with Frances.
Yes, we can do these in Florida, and I look forward to talking to you, Gabriel.
Okay, great. Is there a prepay on the new loan on the new home, not the bridge loan? Darren wants to know that one.
On the new purchase transaction of the new property, assuming that we're not going to bridge that property, there would be a prepayment. Well, we can offer you a no prepayment. I can offer you a 1-year prepay. I can offer you a 2-year. I can offer you a 3-year. And of course, you understand that there's going to be a different rate and cost associated with all 4 options. And depending upon where the market is, that's going to adjust. Can I do a no prepay? Yes. But I think that then where you might be going is to a conversation of fix and flip, which we should have.
Okay. How can the bridge loan work if the property being sold is currently encumbered? Will LendSure do a second on the bridge loan? Or second as the bridge loan?
We'd pay off the first lien and go into a first lien position on the bridge loan. That would leave that investor mortgage free, still collecting rents for that period of time that they own the property up until 6 months is due.
Right. So even if they refinance that property at a 4% interest rate and it's interest only, and they did that during the heydays of no appraisals and all that fun where we were making all the big bucks, you're still assigning them with a no payment mortgage. Hence the sell.
Okay.
What you should be pushing.
If the property has to be listed prior to the bridge loan, are you advising they repair the property while it's listed for sale?
That could be an option. So we're looking for a listing agreement is really where our kind of our rule on that falls. Too bad Joe's still not on the call, but he does speak to the transition of being a real estate investor and dealing with non-owners. You're dealing with tenants. You're dealing with people moving in and out of properties. You're dealing with properties that you want to possibly rehab. One of the biggest selling points to Joe about this program, to him personally, is having the time to be able to do both. So the new investment property that he's going to acquire in this 1031 reverse is an example that property may need paint and carpet. It may need more of a rehab than that. So there's no incredible hurry except for the IRS rules to be able to do that when you're mortgage free on the departing property, still collecting rent.
On the 6-month bridge with no payments, is that, what's the interest rate? And is it added to the price balance at payoff?
Yeah, so it's a daily accrual. You only use the interest that for the life of the loan. So whatever day it's paid off is where that interest cycle stops. I believe the interest rate on it today is 9.5 on today's November's rate sheets. 9.5%.
9.5%, no payment. Interest only accumulates once it closes. I believe the percentage goes down and it goes up to 75% on an owner occupied bridge. It's a beautiful product.
Yep.
Think about what you're selling in the conventional space today.
Okay. In this Bozeman example for the bridge loan, can the purchase loan be paid down and or recast after she sells the Bozeman property?
It's a good question. So we do have an interest-only feature, and if the investor chooses the interest-only feature, you have the ability to pay down principal and actually have the mortgage payment recast to the new principal amount. That's a beautiful option for investors that plan on staying in that product. For those that don't plan on staying in the product, as long as they're in that loan for the term of their EPO, then the loan officer could be looking at a third loan if they have a possible refinance that they want to do. If they can find a source of funds that's lower than the 9.5% that are, our purchase money, actually it wouldn't be 9.5%, that's the bridge. Whatever our terms would be for the purchase money, if they find more favorable terms, that could be loan number 3.
Yes, and I have to go off of that, even though I know that we're probably run on time, but it's one of the conversations that I always have with loan officers is this, that if you're talking about a 1 loan, a 2 loan, a 3 loan, and you think about the positioning the bridge alongside the new acquisition that, yes, has an EPO associated, has that prepay, depending upon if you want to go with a no prepay, but you're still up against an EPO, depending upon what company you're with and doing business with, LendSure with. Putting them into the interest-only product whereby we are qualifying on the IOTIA basis, not the PITAA, not on a 20-year AM, none of that QM stuff. We're qualifying on the IOTI. It's an easy qualification, and you're benefiting on the ability to pay into the principal should the borrower want to pay into the principal once the property sells, so that they can lower their balance, their principal balance, and their payment is immediately recast. And then position you to be able to sell a third loan. Let's pretend that the market's just going to adjust and we're going to suddenly be selling 4.5% again in a year. Or maybe they don't, but you get them into a longer term loan 6 months downstream. Understanding it as a 3 loan process for you, not for my investor. I can guarantee they don't want me talking to you about that. But I'm talking to you about that because I'm a salesperson. And then you have 3 loans where you just made triple the money.
So how the bridge loan program works. I think we just talked about a lot of this, but let's go over it just as a recap.
Is this me?
Go ahead, Francis.
It's both of you guys. Go on.
You go ahead, Mark. I feel like I've been talking too much.
A bridge loan allows the borrower to make an offer to buy another property without having his departure property under contract. Therefore, the borrower buyer can make a non-contingent offer for the new property. Again, I can't stress this enough. Cash buyers are winning in today's market. Contingent buyers are losing. No ticking clock. Buy yourself the luxury of convenience and time, both when purchasing as well as selling. We've talked about the transfer a little bit. 2 separate loans, bridge loan on the departing and the purchase loan on the new property. We're looking to do both. We're even considering expanding into just having a bridge loan option only, but currently we're looking to finance both sides of the transaction, the bridge and the purchase. And then lastly, single balloon payment due when the home is sold. That includes deferred interest. No hit to DTI for bridge loan, no payments due. So Some of the questions that I get asked are, well, what's included? How do you make it, payment free? Well, we actually impound that loan so that taxes and insurance are paid for that 6-month period. We do that so that it is 100% DTI free, and we're able to not hit the new DTI if there is one with any type of payment for the calculation. Most of these, we have a feeling, are going to be DSCR loans, so that won't necessarily be the case. But if you're looking for enhanced pricing, you could try and bank statements or even asset qualification or depletion.
Okay.
And try the bank statements and the asset qualifier if you're trying to exercise the most leverage. I always, over the course of the last 2 years, I saw so many loan officers love the ease of the DSCR product in the sense that the paper itself is so much easier. Now, I think asset qualifier, I think about that, but then I think about it, are my rents going to come in on a 1007 or a 216? And if you're running up against that and you can actually increase your loan size and turn it into an asset qualification loan, whereby I believe truly that we have the most aggressive product in the space, divided by 60 months, if funds can be used for investors, et cetera, go that route. Have the conversation with your AE. Don't just think that you're structuring the LO, structuring the loan and bringing it in. That's why we have the pre-qual process that we have. Work with your AE to structure that process up front so that you can maximize your commission.
So Rose, I know this has gone on quite some time. I just want to do a quick recap. So we talked about the 1031 exchange. We allow those. We do those. LendSure will do a 1031 exchange. We talked about a reverse 1031 exchange. We're one of the few non-QM lenders that I know of that will do those with a smile on our faces. We know how to do those very well. And then lastly, we have a reverse 1031 exchange bridge loan. And that bridge loan is very unusual to the industry today. Thank you for joining our call. You have some information that most people in the industry that they simply don't have today. My insights with the QIs that I've reached out to form a referral relationship business with, as you guys call us, we have a person to transfer them to. Every single one of them says we're the only ones they know of doing this in the country today. So the bridge loan could be your next best friend in today's market. And that's really all I got to say. Rose, anything that you want to add?
Well, I want to get through a couple more questions. TJ just asked, do we have some marketing material for this? In about an hour, you're going to get our marketing resources kit. And because this is so hot and so new, you're going to have information on our bridge loan. I'm going to include an email template, flyers that you can distribute to your borrowers or to your realtor partners, a bunch of really good stuff there. We don't have the 1031 exchange stuff there yet. It's hot off the presses, and I'm working really hard to get some marketing to you guys, but that's not quite there yet. Hey, can we do a bridge loan on a 5 to 8 unit? Enrique wants to know. Enrique, that's my dad's name.
So the 5 to 8 unit is a product all of its own. We could investigate on an exception basis, but my hunch is we would have trouble.
What's the minimum loan amount for a 5 to 8 on a DSCR?
Different product. Francis, do you know?
I would say on any 5 to 8 units, send me the piece of collateral.
It would be hard to find a 5 to 8 unit that wouldn't meet a minimum loan size just because there's so many units.
And yes,
let's talk about then the simple question is tell me also about the cash flow of the property, and then let's talk about doing more than just that one loan. Let's do 10, 15, 20 of them.
All right, and then I think we addressed most of the questions here throughout. If I missed a question, I apologize. Please go ahead and respond to the email that I send you in about an hour, Rose Waldy, and I will make sure that all of these questions are addressed. And yes, I'm getting a lot of flack about the CPA questions. I'm sorry. It's my fault. What I'm going to do is I will compile all of these CPA questions in one way or another, whether I have
Rose, maybe we do another one of these and then interview a CPA that's willing to come on with us. So
a CPA and a QI, I think that's a great idea.
Yeah, there you go.
we could do that moving forward. So with that, I want to take a moment and say thank you, everybody who took the time in joining us today, and we look forward to hearing from you. And again, if you reach out to your LendSure account executive, reach out to me directly, and I will be happy to connect you with an account executive here at LendSure. So any parting words, Mark?
Nope, that's it. Thanks so much for having us.
Francis, any parting words?
Thank you, everyone, and let's do loans.
All right, thanks everyone. Have a good one. Bye.